Well, it's Jonathan Wellham here at ROCKLINC Investment Partners, and I'm here with Jesse Vandermeer and Andrew Cheng, and we are looking forward to our fifth webcast this year. And below the screen there that you're watching, you can actually snap on the presentation that we're going to be going through, and that would be helpful for you because we'll go back and forth between you looking at ourselves and we're talking, and also then the presentation. So we've entitled this presentation Year in Review and Locked and Loaded for 2020. So we'll get right into it. We've got quite a bit of content that we'd like to communicate through for our investors. The outline of the presentation on the next slide, if you're going through the slide deck, just talk a little bit about our investment philosophy. We always want to emphasize how we invest and why we're in certain areas and so on. A little bit about the investment challenges, which we have talked about previously. A year in review. Let's look back upon the first 11 and a half months of 2019. It's been an amazing year, an incredible year in terms of investment returns, but that also means we have to be careful looking forward. So we'll talk about 2019. And then how we're prepared for 2020, locked and loaded and ready to go for 2020. And then we're going to swing into some highlights on a couple of our major holdings. And Jesse will be talking about a couple of our real estate holdings, and Andrew will speak about Ecolab. Okay, so that's where we're going to go. So let's just jump right into it. And I'm just going to go to the screen here so that I can keep up a pretty good pace and you can follow along a little more easily here. So just one moment, and here we go here. So there's the first slide. It's also very important I talk a little about the disclaimer. There are the disclaimers, the legal issues that we need to cover off, so please, you can reference that. And the overall presentation in terms of our highlights are what we're going to be walking through here. And note that our next webcast will be March the 12th, 2020. Okay, just a quick overview of ROCKLINC. We're now up to about $150 million, approximately 130 households, and we focus on customized portfolios. All our clients know that. We're independent in our thinking. We spend all of our time really just studying, researching companies, talking to managements so that we have a deep understanding of those investments. And then we try to have a strong view, a world view, if you will, looking at the current realities rooted in an understanding of the past and how markets really work, and not being naive in terms of how we approach things. And that means a strong world view. Our investment philosophy continued. We buy very strong companies, and we've talked about this before, so I won't belabor the point, but we're looking at the economics of the businesses. We also run focused portfolios. We're the opposite of passive investing. We're the opposite of index investing. We want to have a handful of companies we know well, are well positioned, and should be able to make a lot of money over time for clients. We take a longer term holding period. We're not trying to time the market and speculate. We're looking for great companies, and we want to tax defer our compounding. As you know, you don't have to pay taxes on your gains until you sell. And so if we can defer taxes by compounding our wealth in great companies, you'll do much, much better over time. We want to be careful what we pay for the businesses. So that's what we mean, buy at a margin of safety. We do a lot of valuations, make sure we're buying the companies at attractive values. And then understanding the economic backdrop, and we'll be talking just a little bit about that today, is important because you always have to contextualize your investing. Investment challenges really have not changed since we've been doing the webcasts, and really over the last 10 years that we've been running ROCKLINC. There's debt issues across the world. We have governments that make promises there's no way they can keep, and that's going to and has led to issues. We have an aging population across the world with few exceptions. So we have this, the problem of not enough youth coming along to pay for the costs of the aging population. And that's starting to really sink in more and more countries around the world. Monetary policies, which we've talked about in the past, are crazy in many regards. I mean, they're really out of control. Printing of money, record low interest rates, actually negative interest rates in some countries still. We've talked about that in the previous webcast. These are policies that are on the fringe. They're on the edge. They're trying to keep the economy going with a lot of debt, and these should concern us, and certainly they impact how we invest. And then you have the increasing size of the state. Around the world, with the exception of very few countries, you have the state becoming a larger and larger part of the economy and crowding out the private sector, leading to lower growth rates. The big exception to this would be the United States the last 3 years or so, with the deregulation and increasing competition in that market that President Trump has brought in. But around the world in most other areas, it's a big, big problem, especially here in Canada with much, overreaching governments, particularly at the federal level. Key implications of investing for us. These are very important. I'm going to mention them very quickly, but it's difficult to end money printing. We've talked about this with our clients as we meet with you. We are addicted to debt. We're addicted to this helping out of the central banks, as low interest rates, and it's going to be very hard to get off these interest rates, these low interest rates. And that's why we say it's impossible, in our view, to materially increase interest rates without a recession. And so we've got our backs up against the wall, so to speak, in terms of the policies that have been in place the last couple of decades. That's why we favor hard assets, tangible assets, real assets, scarce assets, proven business models, because it's harder to depreciate the value of those companies if you're using aggressive monetary policy and printing money and creating inflation. We want to be in inflation hedged kind of investments. We have increasing exposure to monetary substitutes. We talked about this in previous presentations. We have around 20% of our clients' equity weightings, and that's important, not necessarily the overall portfolio, because our clients will have some cash and bonds and so on, but 20% of our overall equity weightings, we want it to be firmly entrenched in businesses that can protect ourselves from the monetary insanity of our central banks. And then we keep firepower around to take advantage of market volatility. So year in review, just really looking at 2019, as I say, all I can sort of say to you is like, wow, it's been an amazing year in terms of capital growth. We can even call it the easy year because a lot of things went up. Very few things went up, except for cannabis stocks. And of course, we don't own any cannabis stocks, and nor are we interested in the sector, but that area was one of the weakest areas, interestingly enough. Second, we'll just talk very quickly about the Federal Reserve policy last year. We call it the Great Reversal, the Great Pivot. They completely changed their view as we got into 2019. And that was one of the greatest reasons for the stimulus in the capital markets and increasing values. Global central banks are on the same page as the Federal Reserve, easy money everywhere. And then we'll talk just quickly about ROCKLINC performance. So on this slide, you can see that basically the rising tide lifted all boats in 2019. From the Dow Jones Industrial Average, which is on the top of the page there, up 20%, to the third one down there, S&P TSX, that's the Toronto market, it's up 22%. This is year to date to the end of November. And you can look at gold up 14%, oil up 21%, the MSCI World Index up 20%, 21.7 actually, to the end of November. The point is, it was a very, very positive year. You can look at the bottom. I've got a couple of red numbers there. Energy, oil, and gas in Canada, that would be the exploration and production companies. They took it on the chin, largely because of just terrible, terrible policies in Canada towards our oil industry. And cannabis, which was the hot area to be in, we had all sorts of clients saying, are you interested in cannabis? Which we weren't really from an ethical perspective nor from a business perspective. The top 3 companies that trade on the TSX, so we're not looking at little companies, but the top 3 were down on average 40% last year. So not a good year for cannabis. They sort of went up in smoke, if you pardon the pun there. And then looking back beyond 2019, this is a slide that you can look at your own leisure afterwards, but we just included here because it's quite fascinating to look at the S&P sectors. This would be the big sectors in the US market, and you can see how they've performed over the last 10 years or so, and by sector. And you can see that in 2019, it was very, very positive. And so we want to be careful going into 2020. We're going to shift our thoughts over to looking forward. But this gives you an idea that 2018, we had a lot of negativity in the last quarter. And of course, that makes 2019 look a little bit better if things get positive. And so we are warning and telling our clients, look, we want to run great numbers over an extended period, but 2019 is a bit of an anomaly, and we want to be careful going forward to protect your money and to be able to grow it at a sane rate over time. So this chart, you can look at that in more detail later. This slide really gets to the issue of the central banks. You might say, well, what's going on here? This is really the level of money that's been added to the US banking system. So this is what they call the balance sheet of the Federal Reserve. And you can see it started back in 2015, it reached a level of about $4.5 trillion. Now, before the financial crisis, it was around 800 billion. And so it went from 800 billion to 4.5 trillion. And that means they just printed that much money. So you can do the math and figure out how much new money they put in the system. Now, in 2018, they started to pull the money out of the system. And that's why the curve all of a sudden, which is flatlining there from 2015 to 2018, starts to drop. We call that quantitative tightening. They're pulling money out of the system that they'd printed and added. And this was one of the reasons for the market to go somewhat negative, quite negative actually, in the last quarter of 2018, and for the bad results in 2018. That spooked the central bankers. That spooked the global capital markets. And when you look at the very end of that chart, you can see all of a sudden it goes straight up again. It starts working its way back up again. And this was really the impetus in 2019 for the great markets. The Federal Reserve started to print money again, and they reversed their policies on interest rates. They went from a year ago in December saying interest rates are going to continue to go up, and economy is going to be able to take the increasing interest rates, to within a month or two after December 2018, completely pivoting, completely reversing. And this was really the impetus for a lot of growth in the capital markets so far this year, and therefore we want to be careful. This slide just shows the various central banks. You have the red is the Federal Reserve, and then you've got the purple, the ECB, the European Central Bank. Bank of Japan is in green, and then the Central Bank of China is that orange. And you can see since 2007, all the new money that's been added to the system. And of course, this has been very positive for the capital markets. But it's not sustainable. So again, we want to be careful, and you can see how those charts have continued through 2019. You basically have all of them sort of perking back up again. In other words, aggressive monetary policies across all the major central banks. This slide here, the next slide that's up on the screen, just correlates, or it matches the increasing money supply with the performance on the big S&P 500. In other words, how do stocks do when they're printing money? They generally go up. And so it shouldn't surprise us that last year, as they reversed policy, the stock market went up. And again, the whole point of showing you this is that we want to be careful. We want to make sure our focus on good businesses, solid businesses that can weather more than just monetary policy, and are not just being spiked by artificiality. That's critical in terms of our analysis. And then just lastly, in terms of the looking back, this is just a performance summary. So on this page, you're really looking at our overall book of business at ROCKLINC, which is about 70% equity, 30% non-equity. So it's almost like a balanced fund, if you will. And this is across our whole book of business. So you can see that over the last year, which would be November to November, because this is the end period, November 30th, we're up about 18.8%. And we've been averaging now, after fees, compound rates of return 10% per year over the last 3 years, and over 5 years, well over 8%, 8.4%. Now, our equities on this slide, if you want to just look at how our equities have performed, you can see here we've compared them to the TSX, which is the Toronto market, and the S&P 500, the big US market. We've largely trounced those markets when it comes to our 100% equity exposure, particularly over the last year. We're up 26% in our equities year over year at the end of November. And you can see the TSX 14% and the S&P 16%. But even if you go back 5 years, we've been very fortunate. We've been growing at just under 13%, 12.9%, and that trounces both the S&P and the TSX. Quite a bit. And we have a blended portfolio of Canadian equity stocks. So we're very pleased with those returns. But I would caution, the last year with a 26% rate return, it would be virtually impossible to duplicate that in 2020. So please keep expectations at a modest level going forward after such a year. What does that mean in terms of being locked and loaded for 2020? A couple of things that we like to emphasize, and let me just run through these quickly. How are we positioned? Number one, we have proper diversification across different asset classes, stocks, bonds, sectors within the stock market. We're going to talk about real estate and some industrial sectors today, but we want to be across a number of sectors and geographic regions. So we're not just stuck in one country. And we have talked about the areas that we've been focused on before, and we have them up there on the slide, and you can look at that at your leisure. We invest in businesses with strong balance sheets backed by hard and tangible assets. This is very important when you have aggressive monetary policy going on, and monetary policy that's not going to be easily reversed. Third, we invest in businesses that produce essential products and services in long-term growth industries. And we talk about this all the time. We're not buying flash in the pan businesses, companies we're going to own for 6 weeks, 6 months. We want to own them 6 years, 10 years. We want great long-term industries. We try to avoid, on the next slide here, number 4, avoid highly leveraged financial firms. That's why we don't have a lot of banks. You don't see us in life insurance companies and some of these businesses that are really just stacked full of financial assets and derivatives. We're very, very cautious about that. And that has been very helpful for our clients. And I think it'll be even more helpful going forward in terms of avoiding problems. And we maintain liquidity in our portfolios. Cash is not trash when the markets become irrational. You're glad you've got the cash, and then we can deploy it at very opportunistic moments. And then lastly, in the 6th position there, 6th point, be optimistic and opportunistic. In other words, we're always looking for opportunities. Bad markets bring opportunities. Turbulent times can be very rewarding. And so that doesn't scare us out of the market. And then the last slide that I have before I'm going to hand it over to Jesse Vandermeer to talk about real estate is, look, going forward in 2020, expect more headline risk. I mean, today we're getting more information on, tariffs. Are there going to be tariffs? How's the trade talks going? That doesn't bother us. That's just the way the world works. And so good businesses aren't going to be impacted by tariff talks over the long term. Focus on impeachment of President Trump. I mean, this is the crazy things that are going on within the U.S. government south of the border. We ignore that. He's not going to be impeached. And so we're focusing on businesses that will weather the ups and downs of the political swings and swings of the day and so forth. Geopolitical skirmishes, they're all over the place. Again, we're focusing on businesses and companies that are survivors for the long term. This second point is important. Valuations are at the higher end of historical averages, and therefore it is hard to find companies that are really cheap, and we're working hard at that. But I think, again, I just point out our clients should have expectations that are modest for 2020. We just want to emphasize that. The growing debt concerns, this is another issue that's top of mind for us. Countries are growing their debt faster than their GDP, and that's critical to understand. And therefore, again, we want to be very careful. The markets, again, at some point will have to adjust to this. And then more focus on central banks. I think it's fair to say that as you listen to the news, and every time a central bank has a meeting, everybody's riveted to what the central banks are going to do. And so I think in 2020, there's going to be continued focus on central banks and how are they behaving in terms of interest rates and printing of money and so forth. And again, we want to be in companies and businesses that will survive interest rate swings and also monetary changes in terms of money supply. So with that, I'm going to head back to the presentation and take us out of the presentation and back to our screen here. And I'm going to hand it over to Jesse now to talk about the real estate sector and a couple of companies that are in almost all of our portfolios that should interest our investors. So over to you, Jesse.
Thanks, Jonathan. As Jonathan mentioned, I'll focus on our top two REIT holdings today, and they are Choice Properties and First Capital Realty. First Capital is actually transitioning to a REIT structure by the end of this month. Currently, it's a corporation. So firstly, I'll cover off what is a REIT for those who are not familiar with the structure. A real estate investment trust is a company that generates its income through the development and leasing of its properties. It'll pass the majority of its income as dividends to its unit holders, which means it has a very little or no tax at the corporate level. There are some advantages of REITs, and these include a stable income, firstly, as you'll see on the slide there. And REITs are often known then as bond proxies due to the stability and predictability of these cash flows, which are easily priced. Then they move around with interest rates like bonds do, but because they are equity, the unit holders do enjoy the upside due to the increase in the value of the assets. Secondly, it's a low-cost form of ownership of real estate with low transaction costs. Many of you are, of course, experienced with the realtor fees, the land transfer taxes, and so forth. Owning a REIT, a publicly listed REIT, it's very easy, very liquid. So that's one benefit of a REIT there. And then thirdly, you have exposure to certain segments of the real estate market you might not normally get as an individual investor. These include commercial, industrial, even hospitality, real estate, and so forth. And as we know, each of these kind of subsegments of real estate has its own market, own characteristics. For example, Class A office real estate in the metropolitan markets have very low vacancy rates in core urban markets such as Toronto. Industrial property in the GTA specifically has done really, really well, especially those geared to e-commerce. So it's important to have a diversification of real estate subsegments as well. And then fourthly, in a world of low interest rates, these REITs in your portfolio, they provide a really nice, attractive, risk-adjusted yield. Like Jonathan mentioned, central banks are buying all across the yield curve, pushing down interest rates. So owning something like a REIT really adds kind of a nice buttress, a nice income-producing aspect in your portfolios. Moving on to the next slide, I'll start focusing on Choice Properties firstly. Choice was actually spun out of Loblaw Limited. It's 75% of its portfolio at that time. So this mainly comprised of Loblaw-related grocery stores, pharmacies, etc. And that Choice then, publicly listed in 2012, built on that strategic partnership over the years. Since then, it's also diversified its asset base, which is nice to see as well. Add some nice diversification. Currently, Choice owns 725 properties. And a reason we like Choice and a thesis, if you can sum it up, why we own Choice, is that Choice really focuses on retailers and other providers of goods and services that focus on providing basic necessities that we use every day. And hard, in the age of Amazon, those that pose less a threat of being Amazon-fied by the e-commerce industry. So these include grocery stores. Many people obviously still get their groceries at grocery stores. Gym, it's hard to go to the gym online. Banking, a lot of people still go in to see their banker. Think of when you're applying for a mortgage. So they really focus on these basic necessities, which is why we like Choice. If you break down their portfolio, they have 576 retail properties, 112 industrial properties, 15 office complexes, 4 multifamily residential properties, and 19 development properties. Now I'm going to throw up the slide on the screen here. And Choice recently, last year, acquired a REIT, a Canadian REIT, CREIT, as it's commonly known, and it announced a $6 billion acquisition of this REIT, and it's Canada's oldest public REIT. So now it's added 206 high-quality properties to Choice's portfolio. This combination actually creates the largest REIT in Canada by size, with a $16 billion enterprise value, meaning market cap plus debt, And this provides nice diversification and a long runway for development and intensification opportunities for Choice, particularly in these core urban markets. I have that diagram there on the slide, and this shows an example of this intensification and the value that can be added through these development activities. So what that diagram shows there is of Choice's properties along the Golden Mile, and this is in Scarborough, along Eglinton Avenue. And the now planned mixed-use residential developments, it's actually on existing Choice properties. A lot of the parking lots where Choice already leases out to grocery stores and other retailers along that stretch, it's actually utilizing the land it already owns, and now it will develop that. So that's the wealth generation and value add that Choice and great management adds there. Here's another diagram that really underlines the value that CREIT adds in terms of diversification. So firstly, we have asset class diversification. Choice had a high exposure to retail, but CREIT offers nice office and industrial exposure. Next, we have tenant mix. Blah blah was a big chunk, a vast majority of the tenant of Choice, whereas CREIT has everything but blah blah. So that's nice to see. So the new organization's more 60-40 split. And then lastly, you have the addition of more concentration in primary markets. As we'll see with First Capital, we like to have a focus on primary markets, more predictable, longer-term growth trends, etc. So CREIT adds increasing exposure to these primary markets with higher densely populated areas. Looking at First Capital, which is our second main top REIT holding. First Capital is a Canadian real estate company that focuses on the development and leasing in super urban markets. So densely populated areas with strong demographics that is expected to continue over time. And they attract high quality tenants with growing rent potential. So they have a portfolio of 166 properties, and to kind of underline this super urban target market, they average 280,000 residents within a 5-kilometer radius of its properties. And the company's rents are 26 higher than the peer group average. So First Capital, if those familiar with Toronto, they're really heavily involved in Liberty Village and Yorkville Village. And this is an interesting aspect of First Capital. Like I said, it's super urban, so think of the major metropolitan markets. And within those markets, First Capital really focuses on acquiring properties that are close together in the same neighborhood or even adjacent to each other. So they can really control the appearance, the tenant selection, and character of that neighborhood and drive value also from that. So that's an interesting aspect of First Capital. And they've done that really well in Liberty Village, which has a great neighborhood character and appearance, all very similar. And Yorkville Village, particularly ritzy, they're able to kind of have great tenants and also drive higher rents from that. Like I said, First Capital is transitioning to a REIT structure by the end of this year. And there's 3 main benefits that has. Firstly, it expands the shareholder base. Certain funds, certain institutions, especially when targeting a certain aspect of the portfolio. If you're not a REIT, you're not being included in a REIT index or funds and so forth. So expanding that shareholder base should theoretically increase the price many investors are willing to pay. It also enhances comparability with peers. The tax structure is slightly different. There's very little tax at the corporate level because it does pass the majority of its income to its investors. And then lastly, it is a more efficient vehicle to hold property assets. So for those reasons, Choice and First Capital is a staple within client portfolios. They offer great diversification. Each has a great strategy, slightly different, slightly with different nuances. But the managements are great, and it provides, again, primarily a great income-producing component of your portfolio. I'll now pass it over to Andrew, and he will take it from there.
Great, thank you so much, Jesse. If you've ever been to a grocery store, restaurant, public washroom, hospital, or hotel, chances are you have come across one or many of Ecolab's many products and services and not even know it. Ecolab is a trusted partner to many of the world's largest corporations. It has a diversified customer base of over 3 million customers that span across a wide spectrum of industries, which helps increase even the greater diversity of this company. Some of its well-known customers that you might have heard of is Costco, Chick-fil-A, Marriott, Walt Disney, Walmart, Nestle, a whole host of very high quality companies. Ecolab offers its customers a value proposition in twofold. First, it has a dedicated team of 27,000 field associates that work directly with its customers and helping to develop customized, personalized solutions to be able to help address its water, its hygiene, food safety issues and challenges. Now, when it goes into a customer, they start off with having a field visit and analyze the entire business operations and identify certain areas that might need changes or improvements. Not only do they provide products and services, but they help make it more efficient. And that's the other value proposition that the company offers. The company provides detailed services to its customers that help improve the efficiency and the productivity of its products. So for instance, in 2018, Ecolab helped its customers save 188 billion gallons of water. It helped conserve 19 trillion BTUs of energy, and also provide food services to over 45 million people and help clean its hotel, over 1 billion of hotel rooms. I'm just gonna move over to the next slide so you can see. Okay. Okay. Sorry about that. Ecolab is able to offer this value proposition and help its customers make their operations more cleaner, safer, and more efficient. It does this by offering a unique strategy called Circle the Customer and Circle the Globe. So Circle the Customer allows Ecolab to offer a comprehensive offering of the solutions to meet its customers' various needs. Circle the Globe, as customers grow and expand their business, they need a partner that's able to grow along with it. And so Ecolab has on-the-ground operations in a variety of different geographic locations to be able to help address its customers' needs as it grows. On this next slide, you'll see that Ecolab organizes its business into 4 main business segments: global industrial, global institution, global energy, and other business, which primarily includes its pest elimination and colloidal technology. So starting with the global industrial business, this business provides products and services across a diverse group of industries. Now, one of the primary concerns of the food and beverage industry is the prevention and elimination of foodborne illness and contamination. Ecolab offers a comprehensive suite of food safety solutions, such as cleaning, sterilization agents that are used throughout the food processing cycle to help dairy, meat, poultry, brewery, winery, and beverage, and other food processors meet strict food standards. Water is a critical function in many operations. Ecolab offers water treatment, reuse, and recycling solutions to light industry, which includes the food and beverage, manufacturing, transportation, and institutional customers with water treatment, water reuse, and recycle solutions. The heavy industry consists of the chemical, power, metals industries, which uses Ecolab's products and services to manage their water use and reduce costs. For instance, Ecolab offers products used to evaluate and treat the entire wastewater system of a plant's operations. Within the mining industry, they face environmental compliance and sustainability requirements. And so Ecolab provides products to help meet their compliance needs. For example, they provide services and products to help treat raw and processed water. Within the life sciences and pharmaceutical industry, these companies require a strict, similar to the mining, regulatory compliance and operational efficiency in cleaning and sanitizing and maintaining contamination control. Ecolab offers customers with cleaning and disinfection programs to help sterile their environment. The next business segment is global institutional. So global institutional covers across various different industries. So starting off with food services, Ecolab provides cross-contamination prevention solutions to help reduce food illness. That is definitely an issue that would want to be prevented if you are a food supplier. It is also a market leader in warewashing. So it provides all of the detergents and on-site cleaning tools for restaurants to be able to clean their dishware, glassware, cookware, and utensils. Within food retail, very similar. They need to prevent foodborne illness and maintain a clean environment. And so Ecolab, they provide food retail service programs that are personalized for food safety, cleaning, and pest elimination. They also help its customers with conducting comprehensive food safety audits. Within the hospitality industry, Ecolab provides commercial kitchen hygiene products that kill bacteria on the floors, drains, grease management. Commercial buildings and facilities, Ecolab has cleaners, disinfectants, sanitizers for these public spaces in commercial buildings, hotels, and universities. Long-term care facilities, healthcare facilities face a very difficult challenge in preventing infections, specifically hospital-acquired infections for its patients. So Ecolab offers cleaning, disinfection, hand hygiene, instrumentation, reprocessing solutions to help prevent and eliminate the spread of these types of pathogens. The next business segment is global energy. Global energy, they provide solutions, on-site solutions for the petroleum, petrochemical, and natural gas operations. They also offer water treatment for refineries and petrochemical plants. Products are used to help improve the efficiency and useful life of customer assets and prevent corrosion of their assets as they're being used. And they also have programs to identify, diagnose, and treat petrochemical processes and water-related problems. And the last business segment is pest elimination. So Ecolab is one of the leading suppliers of pest elimination programs to commercial hospitality and institutional markets. They not only provide these services when there's an issue, but they seek to be proactive and eliminate customers even seeing a pest before they're even needed to provide more extermination. So as you can imagine, they provide devices to capture and prevent rodents, insects within restaurants, food, and beverage. So they're very important, very pertinent to these types of operations. Now, on the next slide, I'm just going to go over the reasons why we like this business. So I just went over just what this business, about this business, and I'm going to explain kind of the reasons why we like Ecolab. So Ecolab has a predictable and stable business model, and very similar if you've listened to other podcasts about the rationale, is that we like companies that we can be able to foresee its profitability. Ecolab plays an important role in offering value-added services to its customers, and it is critical to the operations. This is why its customers continue to go to Ecolab for replenishment for these consumable products. And this is why it has a recurring revenue of over 90%, giving Ecolab a fairly stable business model over time. Ecolab also has a diversified customer base across industries. And so this helps dampen the loss in the event that there is a struggle with one specific industry. Ecolab has a differentiated valuation proposition. So it works directly with customers to provide on-site support and help. So Ecolab's teams develop and implement personalized solutions that are reliable and cost-effective. And service teams will go into an operation and use data analytics to be able to capture insights to be able to help improve the efficiency of the operations and help customers meet its compliance requirements. So for instance, Ecolab has a software called 3D Tracer, and it uses proprietary sensors, algorithms, and chemicals to detect and measure water contaminants every 6 seconds. So very helpful for its customers. It also provides customers with thousands of hours of on-site classroom e-learning for helping for best practices. This enables the company to help develop strong partnerships with many of these world-leading companies by providing dependable, high-quality products and services. Ecolab is also a prudent allocator of capital. It makes strategic acquisitions where it believes it will complement its existing offering or expand into growing areas or geographies. So one key acquisition that was made in 2011 was the purchase of Nalco Holdings, which is the company's largest acquisition to date and is now part of Ecolab's main water business. Now, this acquisition helps strengthen its water portfolio considerably and broaden its reach into various industries. Recently, the company has been focusing its investments in digital enablement. So as companies continue to collect more data, they're able to use their systems to provide insight into actionable and useful decision making. The company has deployed $380 million in digital investments over the past 2 years. In September of this year, the company launched its cloud-based digital platform called Ecolab 3D that leverages data analytics to provide real-time analysis that can be used to help optimize customers' assets and reduce water usage. And lastly, Ecolab's stable business model, differentiated value proposition, and strategic capital allocation translates into strong financial results. This is what we like to see in a company. From 2009 to 2018, revenue increased at a compound annual growth rate of 13%. Looking at free cash flow, which is the amount of cash that a company can produce after subtracting the cost of purchasing assets such as property and equipment, is an important metric that we like to look at to value a company's worth and value. From 2009 to 2018, Ecolab's free cash flow increased at a compound annual growth rate of 17%, which is the type of growth rate we like to see, double digits. And lastly, we believe that Ecolab has a strong balance sheet. And one metric that we look for to see the quality of a company's balance sheet is just the debt to equity ratio. And Ecolab has a debt to equity ratio of less than 1. And that for these reasons, that's why we like Ecolab. I'd like to hand over the floor to Jonathan.
Yes, thank you very much, Andrew. And I apologize, some of the slides there, they got stuck. And so if you want to go back, and again, at the bottom of the presentation, you can actually view all of the slides that both Jesse and Andrew were going through, and myself also, then that might be helpful, because there's a lot of content there. But what we're really trying to emphasize to our investors is a tremendous focus on research and understanding of the businesses. And you can see when it comes to First Capital, Choice Properties, that these are leading real estate companies in Canada with a very focused strategy to take advantage of, in particular, downtown urban developments, which are really taking place at a rapid rate. A lot of immigration into Canada, a lot more people coming to our major cities, and this is leading to tremendous opportunities from a real estate perspective for those companies. And those are very disciplined companies. We talk about to Jesse all the time when we're looking at these companies. We don't want companies that are just going to issue stock and buy real estate all the way up and then take it all the way down again when there's a recession, but disciplined capital allocators. And you really see that in First Capital and also Choice Properties. And you get a nice dividend along the way. Our investors, I know, are looking for income streams, and this provides a very stable and growing income stream for our investors. And then lastly, the Ecolab story, as Andrew has really clearly laid out for us. And again, I encourage you to go back and just look at the various slides. This is a powerful, powerful company. It is a very significant, large company. It's really got a moat around it, great pricing power, and builds long-term relationships with leading manufacturers and healthcare industries and all the different sectors, the restaurant business and so forth that Andrew articulated. So they're examples of the kind of companies that we want to have in our clients' portfolio and give us that depth and breadth and heft in terms of the businesses that we own. So hopefully that has been helpful for you in terms of giving you an overview, a bit of an update. 2019 was a banner year. In fact, over the last 5 years, we've been very fortunate with exceptionally high rates of return. This is our 10th year as a company now. And over the last 10 years, it's been quite the ride. But we need to be careful. We always need to be diligent, and we need to be careful in terms of our investing. Valuations are high. Central banks have been very easy with the money in the spigot. And so we want to be careful going forward in 2020. And we think we are very well positioned to enter into 2020 with a high quality portfolio that can weather the ups and downs that will inevitably come our way. So we want to wish all of our clients happy holidays, a Merry Christmas. And we trust that all of you have time to take some time to be with family, friends, relatives, and celebrate the wonder of the Christmas season this year. And we will be back on March the 12th, 2020. I can't believe it. We'll be in a brand new decade, and we'll be well into it by March 12th, 2020, and we'll have our next broadcast. Thank you very much, and we appreciate your support, and we look forward to serving you in 2020. Bye now.